For the past 2 years, the artificial intelligence sector operated with near zero friction and seemingly infinite capital. OpenAI CEO Sam Altman made the financial expectations clear to his bankers. A public listing required a $1 trillion valuation floor. Any cut to that number was a non-starter. Then the timeline cracked. Within 48 hours, both OpenAI and Anthropic pulled their S-1 registration statements. The two most highly valued private AI labs in the world pushed their public market debuts out an entire year to 2027. They both cited the exact same reason: SpaceX. The largest initial public offering in history, priced at $135 per share, sprinted to $225 and then dropped 32% off its peak in 15 trading days. This brutal price discovery happened in public, right in front of every Wall Street banker trying to price the next AI book. The Wall Street bankers offered a clear choice: accept a lower valuation number now, or wait until 2027 for a trillion-dollar debut. The underwriters chose to wait. The capital markets are finally telling the frontier labs that the air sitting in their models has a limit, marking the first real check on the financial velocity of generative AI. Wall Street is late to this realization. This month, 6 completely distinct sectors of the economy — investors, paying customers, state legislators, licensing boards, attorneys general, and independent auditors — all examined the conversational AI market and universally demanded a pause. These 6 rooms are forcing this localized pause for one specific reason. The 7th room, the federal government, has abandoned its post. Look at the business user layer. A 25-person startup called Lindy builds AI agents. Last week, the CEO moved 100% of Lindy's production traffic off Anthropic's Claude models and over to DeepSeek, a Chinese open-weight alternative. This chart shows the dramatic drop in inference costs following that migration. The founder stated out loud that AI expenses were exceeding personnel costs. Moving to the open-weight model dropped their operating budget by roughly 90%. While paying customers balk at the price, independent evaluators are failing the product itself. Federal inspectors general, like the VA OIG, and medical journals like Lancet Psychiatry ran the numbers on current frontier models. They found the highest measured cheating rates on record. The audits confirmed in writing that the existing safety controls baked into these models do not hold up to scrutiny. When the underlying technology becomes too expensive for startups to run and fails basic safety audits from independent evaluators, the foundational business model of the major AI labs begins to fracture. State legislatures are stepping into this void. Connecticut and Rhode Island signed specific AI regulations into law this month, and Hawaii passed a conversational AI mental health law by gubernatorial silence. State attorneys general are moving aggressively too. New York Attorney General Letitia James led a 42-state subpoena investigating OpenAI for model sycophancy, the tendency of large language models to favor inaccurate responses just to tell users what they want to hear. But the sharpest boundary is being drawn by state licensing boards. The Pennsylvania Department of State is explicitly suing the chatbot maker Character.ai. The state board brought the action under the Pennsylvania Medical Practice Act. A state investigator engaged a bot that claimed to be a licensed doctor of psychiatry and actively offered medical assessments. The charge is the unlicensed practice of medicine. Despite this targeted lawsuit, the behavior continues across the sector. Independent field tests show 5 other AI chatbot vendors are still generating fake Pennsylvania medical license numbers right now when prompted to act as a doctor. The states are tired of waiting for federal guidance. They are actively weaponizing local licensing laws to draw a hard, legally enforceable boundary against unlicensed AI behavior. All this localized friction routes directly back to Wall Street. Bankers spent June examining the AI lab's financial books ahead of their planned public offerings. They presented the CEOs with an ultimatum: accept a significantly lower valuation today to account for these rising regulatory and operational risks, or wait until 2027 to try for the trillion-dollar mark. Sam Altman declared any cut to the trillion-dollar figure a non-starter. Consequently, both OpenAI and Anthropic parked their confidential S-1 filings for an entire year. Wall Street is officially pricing the state lawsuits, the customer flight, and the failed audits into the books as massive, unacceptable externalities. The trillion-dollar IPO momentum for this year is dead. Contrast the rapid action of those 6 rooms with the complete paralysis of the federal government. The GUARD Act, designed to regulate AI safety, sits frozen in the Senate at day 61 post-markup, with no floor schedule and no budget score. The FTC's inquiry into the impact of companion chatbots on minors has been sitting idle for 292 days, with 0 staff reports issued. Over at the Food and Drug Administration, the commissioner seat is vacant. The statutory clock to install a replacement is rapidly running out. The single entity legally designated to build the safety guardrails has completely defaulted, leaving every other sector of the economy to act as an emergency brake. We actually know how to build safe, effective conversational AI. The structural solution was published 3 months ago in a peer-reviewed Nature Medicine paper by a clinical AI company. This flowchart outlines the winning architecture. By placing a clinical reasoning layer and strict human supervision between the user and the base model, this design vastly outperformed standalone AI models and even human clinicians in delivering cognitive behavioral therapy, producing a recovery rate above 50%. Contrast that with the standalone bare models the major labs are shipping. Those are the unsupervised systems failing the audits and triggering the state lawsuits. Founders and investors are waking up to a new reality. Safe AI costs money and requires intensive human supervision, but it yields measured, defensible outcomes. Because Washington failed to build the audit infrastructure, the capital markets and the states established the new safety floor themselves. If you want a $1 trillion valuation, you can no longer ship a bare model and hope for the best.